So there's quite a bit to process this week. Once again, another busy week. And that's not to say that markets aren't going to be digesting what happened last Friday. That surprise out of the Bank of Japan. Hello, everyone. Monty here, market analyst at IGUE. Let's go ahead and get started because quite a bit to process. And we're going to go and start off with some of that economic data out of the US that so far is giving that it's in the sweet spot in the sense that we're getting these stronger data. I know some of it's a bit lagging. So you might say, okay, well, you got to take a little bit with a grain of salt, especially when you're looking at some of the more leading items that are coming out. But generally speaking, it really pushed this narrative that we're in this phase where you're getting the stronger economic data in line with what Feds Powell was saying last Wednesday about his staff no longer projecting a recession. So a sweet spot in that regard. But at the same time, usually you'd say, well, doesn't that mean that therefore, we should be pricing in more rate hikes? Well, not if the pricing data is coming out lighter than anticipated, or not if at least it's moving in the right direction that the Fed anticipates. And that's the reason why you're seeing market pricing keeping the door open. Minority, I've talked about this before, about another rate hike out of the Fed, but not matching the Fed's very own dot plot. And last Friday we did get PCE, or personal consumption expenditures price indices. Light blue means the text, that means that it's better than anticipated. White as anticipated. Red means that it's worse than expected. You can see that the month-on-month headline, okay, that was worse than anticipated. But look at the year-on-year headline. Look at the year-on-year core dropping from 3.8 to 3% and from 4.6 to 4.1% respectively, all in line with what the Fed really wants to see, even if still above the Fed's target. You look at consumer inflation expectations, the preliminary readings were moving in the right direction. Revised figures that we got last Friday for the 12-month managing to stick, for the 5-year dropping from 3.1 to 3%, though its consumer sentiment reading did drop a little bit, 72.6 to 71.6. And then you take a look at the stuff that we got some of the stuff that were last Thursday. Fed's GDP, my goodness, 2.4%, well above estimates. Atlanta Fed's GDP now estimate, by the way, pointing to a whopping 3.5% growth for this quarter. I know the quarter isn't over yet. A lot can happen between now and the end, but that's what they're projecting in terms of growth. Claims initial and continuous lighter than anticipated, which means better than expected. Durable surging when it comes to the month of June. Pending home sales, we got ourselves some growth for the first time. What was it, 3 or 4 months that were either contracting or 0% growth month on month. And then when it came to Friday's personal spending, it was up, better than expected. Personal income was slight miss, but still growing at 0.3%. So overall, very much favoring that narrative. When it comes to the week ahead, there's quite a bit that we have to process, but U.S. non-farm payrolls is going to be on Friday. I like to start with that because then we can work backwards when it comes to some of the jobs data that's going to be released. But you can see it's been a story of better than expected readings for about 14 consecutive prints. And then we got June's reading, which was lighter than anticipated, definitely had some weak points within it. And we saw job growth slow down to 209,000. The expectation, by the way, for July, another month where it's going to slow down a bit. Of course, the estimates are always going to vary quite a bit, but looking at roughly 180 to 200K growth. And when it comes to the unemployment rate, at or near 3.7%, wage growth anticipating ongoing growth of 0.3%. Job openings, this is for the month of June. So those figures are for the month of July. Job openings is going to be for the month of June, and that's going to be released tomorrow. It's going to have to pull back a little bit further. ADP's on Wednesday, but it really missed last time around. It was around, it was around 500K, and NFP was much lower than that. So again, you have to take that with a grain of salt. You might see a bit of a move, but it usually doesn't stick on Wednesday because everyone's waiting to see what's going to happen on Friday for the more encompassing estimates. A bit like when it comes to oil, the weekly oil inventory readings, APIs. Was it Tuesday night, and then afterwards you've got oil traders usually waiting for EIA's more encompassing estimates to really then see if the move can stick when it comes to oil prices. For today, we got the loan officer survey out of the Fed to see to what extent we know credit conditions are tightening, to what extent they're tightening amongst the banks, and then we've got those PMIs. It's going to be crucial. We did get Chinese PMIs this morning. Manufacturing, better than anticipated, but still in contracting territory. Services, a clear miss. And if you look at the figures trending lower, not that far off. I mean, if it keeps going at this trend, you're talking about a month or two, and it's going to be in contracting territory, which means that's more dangerous to see services. I know that for commodity traders out there, they always want to look at the manufacturing PMI out of China, given its manufacturing powerhouse and commodity hungry. But let's not deny that if you're talking about any slowdown, as well as, of course, stimulus hopes from market participants out of the Chinese government, then they are going to have to look at services PMIs as well. But for the U.S. and for the globe, we've got manufacturing. The story is going to be manufacturing contraction, services expansion. That's generally been the theme. And then, of course, we got ourselves some more earnings. Apple and Amazon, tech giants are going to be on Thursday, and we got ourselves for chip maker AMD tomorrow, which is quite significant because a lot of you out there trading and investing in some of these tech stocks, as well as when it comes to the chip makers, if not AMD, at least NVIDIA, which means you kind of got to know what's happening to these companies. And what about when it comes to central bank action? Late last week, I'm just going to briefly go through this for when it comes to the ECB because I want to get to the Bank of Japan. But ECB 25 basis point rate, I got 2.75% deposit rate. No changes there. September expectation by majority is going to be on. They're going to be on hold, especially after some of that data has been a little bit scary. But getting to a peak 4%. afterwards. It's a bit of a coin toss on whether it can happen in November or December. We got ourselves Eurozone preliminary CPI and GDP today, and we got ourselves producer prices on Thursday. Now, when it comes to the Bank of Japan, they were on hold when it comes to their key rate, negative 0.1% last Friday. The leak happened prior, and that's the reason why we saw that big move when it came to the financial markets Thursday night or early Friday morning, depending on where you are. But it's the yield curve control tweak that came as a bit of a surprise, especially because it's not that there weren't people pricing it before. The problem was that the pushback from policymakers from the Bank of Japan saying it's not going to have continuity, surprise. And that kind of is what took everyone off guard, as well as the lack of clarity in terms of how they're going to go about doing it. Because it's not that they changed the ceiling for 50 basis points. It's still 50 basis points on the 10-year yield. The problem is that they're saying, oh, it's more of a reference, not a hard limit. Well, okay, it didn't jump, the 10-year yield didn't jump all the way to 100 or 80 or 90, but effectively, if they're going to trade, or they're going to enter, the expectation is to enter with at 1%. That means that technically, doesn't that mean that the band is closer to 1%? Of course, they can intervene at lower rates. We'll see whether or not. I mean, this morning there was a unscheduled bond buying out of the Bank of Japan. So there's that question of, okay, to what extent are they really going to stick to this? To what extent will they allow a more controlled move, for example, to a higher 1% band? But that still is seen as a relative negative when it comes to the bond market to some extent, and of course that can in turn dent valuations. Especially for some of those growth stocks when it comes to stocks. So the results haven't been negative. I'm not pulling up the trading chart just yet, but the results haven't necessarily been negative when it comes to the stock market week on week. But we did see a pullback when it happened, and then a bit of a recovery afterwards. It's going to be very important to note where those yields settle and how the Bank of Japan responds accordingly. And of course, that means that USDJPY, which is available on our report. Go ahead and pull it up over here. Gone through a little bit of a redesign. We do have USDJPY there, and we do also have AUDUSD as well as GBPUSD given. We've got the central bank announcements from both the RBA and the BoE. So let's go ahead and go through those. Expectation for the RBA tomorrow morning. Heavy majority that there's going to be no rate hike. Market pricing, by the way, courtesy of Refinitiv. And we got ourselves some more data, trade and retail data on Thursday, the monetary policy statement on Friday. And when it comes to the Bank of England, though, at the very least, 25 basis point rate hike. That's fully priced in. Of course, there's the matter of, are they going to go for 50? Almost 100% certain, from my point of view, that there's going to be a split vote in terms of how they go about it. Maybe you might have a member or two voting for 50. There's going to be the sole member left that's going to vote to keep things on hold, and I think the majority is just going to go for 25. It's pretty much what it might look like. Of course, you're going to have to noting PMIs prior, where preliminary was a miss, as well as what has been lighter pricing data. What about when it comes to larger COT speculators? Now remember, this is released on Friday night, but the positions are as of Tuesday. So this is before the BOJ. And the reason why I had to bring that up is because so far they're still pulling back a little, but still holding extreme sell bias in JPY, which means extreme buy bias in USDJPY. It's still holding on. They're just shy of extreme buy when it comes to the euro. And when it comes to the pound, because we're going into BOE there, they've raised their heavy buy majority from 65 to 69%. And when it comes to the Australian dollar, still heavy to the sell side, though keep in mind, they haven't necessarily always gotten this one right. So going back and pulling up, the report over here, you can see that there, as I mentioned, we've gone through a bit of a redesign and got some of the items here, including USDJPY, as well as AUDUSD, where it's the overview on the weekly. These are longer term weekly. It's been more cautious consolidations, going back towards an average, but there have been some sizable moves intra-week as well as intraday at sometimes, which means you just have to be a lot more cautious before going for a reversal strategy. So that's about it from our end. I want to thank you guys so much for watching. Good luck out there, and as always, happy ticks.